All right, there we go. Looks like we're live. All right, let's just make sure we are ready to rock and roll here. There we go. Good. All right. All right, cool. Looks like I'm. Let's see which one's this. All right, cool. Looks like I'm. Hold on a second. Hold on a second. Hold on a second, Big Daddy Kane. Big Daddy Kane in the house. All right. We want to. Got to make sure we monetize this baby so I get some of that George Soros sweet, sweet money when he advertised for Ralph Warnock, the socialist in Georgia. And then John Ossoff, the rich boy socialist in Georgia. Ain't nothing like a rich white kid marrying a wealthy woman and telling us how to live our lives, even though the rich white kid never had a job. That's John Ossoff. That's the Democratic Party right there for you, man. They are woke, and hopefully they'll be broke. All right, so let's make sure we turn that on. There we go. Save that. Oh, is there anything worse than any just rich kid who never had a job in his life? Yeah, living off the money of his wife and telling you, I got nothing else to do, honey, so I'm going to run for office. Ugh. All right, so what I want to do here today, Kevin, what's going on in Arizona? Gladys, hello. Vinyl, Eric, right on. Noonan, Georgia, what's going on, Bill? Where are you coming from? Coming from, Gladys. El Cabrera. Which TSV? Okay. Preferred stocks. Yeah, you should give that a go there, Vinyl. Some guy asked about preferred. All right, so what I was listening to Med Favorite today. It's interesting, and he let me see if I can't find. He interviewed a guy who I'm a fan of. See if I can't find that podcast. Yeah, right here. So here's the Med Favorite podcast, and I check Med out every now and again. He interviewed Toby Carlisle, talk about deep value stocks, and I said that's kind of interesting to me. And Toby said, "Right on, Mighty Monkey, moving from California, Muncie, Indiana, right on, Los Angeles. All right." And Toby was saying, and I don't follow this that much. I find it of interest that he was looking at some stocks. They said these are the ones that we're putting into our portfolio called Deep, DEEP. It's snowing in PEI, right on. Hope you got your fireplace ready. Hey, Joe, it's Huntsville, Alabama in the house, right on. Right on, Daniel. Eli Cabrera is in Lakeland, Florida. Right on, Eli. All right. Anyway, so he was saying, so Deep is looking at deep value stocks, microcaps in particular, but not all microcaps. And it's been a while since I actually analyzed some stocks on this channel. So let's take a gander anyway. And so one of the stocks and this is not a microcap, but one of the stocks that Toby was talking about was Cisco and Intel. So let's take a gander at Cisco and Intel, shall we? I think it'll be fun. And so what we're going to do is we're going to go over here and we're going to go to, and I always go to, for when I'm analyzing stocks, I always go to finance at Yahoo Finance. All right. So we're going to go to Yahoo Finance when it's individual stocks. And I don't do it that much. And look, man, trust me. If you follow me on stock market, that's fine. I'm just telling you. Nobody knows nothing about nothing. Just keep that in mind. Everyone thinks they do. They don't. No one knows nothing. Why? Because we don't know what the market's going to do. No one does. But anyway, so let's look at Cisco. And it's funny because I had to remember Cisco from many, many, many moons ago when I was a trader at Schwab. I was on the trading desk at Schwab. And Cisco was a hot tamale back in the late 90s and early aughts. And then it fell to nothing. And the Med was saying, very interesting, the price to sale at Cisco, price of sales back then was like 30. And now it's 3. And I said, that's crazy. And he was saying, and I haven't confirmed this, I'm just listening to what Meb was saying. He's saying the price to sales of some of these highfalutin stocks that are just tearing it up right now are well above what Cisco was. And I said, that's crazy, because that was in the heyday of the dot-com bubble. And it's crazy because Cisco has not even come back to where it was back then. So let me show you what I'm talking about. So we go to the chart here, and let's go to Max. And this is crazy. So here's a dot-com bubble right there. Remember, that was when the NASDAQ broke 5,000 on March of 2000. And then it just went, I mean, look at that, man. It just, I mean, so here is Cisco at 77, and I'm sure this is adjusted for dividends. I'm sure it is. But anyway, it's at 77, and here is still 44. 77 to 44, 20 years later, 21 years later. Isn't that nuts? And here's a volume. The volume has fallen off. That's interesting to me. And the reason for that is because it's not all that in favor, which is good. Look at that. That's volume. That's interesting. Look at that. I mean, it's still heavy trading, don't get me wrong, but look at the volume just falling off. I find that very, very interesting. Anyway, so let's check the old Cisco out here. So if we look at the again, price of sales was 30 back then. I've never paid much mind to price of sales. I just don't. But that was interesting that Med was saying the price of sales of Cisco was significantly higher than than it is now. It's at 3, but now the high flying companies now are well above what it was back then for Cisco. So what I do when I'm looking at stocks, just to get a gauge if I want to invest in this, and the only individual stock I own right now is Exxon, by the way. That's it. All right. And I've actually turned my frown upside down. So I've actually made a little bit of money so far. But look, I'm holding on to Exxon forever. I mean, follow the Warren Buffett model. You get 20 chips and you never turn them in. That's it. And 20 chips would be the 20 transactions you can place. That's it. You got 20 chips over the course of your life. And you never, that once done with 20, you can't buy anymore. I think that's absolutely the way to go. Anyway. So let's look at Cisco. So the first thing I do is I say, okay, the very first thing I ever do is look at PE ratio. And right now, PE ratio is 18. TTM is trailing 12 months. That's what that means. And that just says what the trailing 12 months in the past, the last year. Actually, I don't know what I'm not sure what what is that based on November? I don't know. But the trailing 12 months based on the last recording date. PE ratio of 18, which is pretty low in this day and age for sure, especially low given the low interest rates we're dealing with now. So that's good. So they're making $2.47 a share. All right. The forward yield now. So here's a couple of things going on. The yield right now is $3.22. That's the yield, and the dividend is $1.44. All right. So that's all stuff I'm looking at here. Now there's a volume, so heavy volume still, but if you can see up here. It's dropped off quite a bit. So it's pretty interesting to me. All right. But anyway, you can still see heavy volume. It's a very liquid stock. So all these people say, oh my goodness, if we had a transaction tax like Kamala, which I actually support, they'd have no liquidity. They'd have liquidity. They might not have 15 million shares trading a day. They might have 13 million. That's still liquid stock. Come on. This whole thing is just nuts. We can't have a transaction tax to destroy liquidity and hurt the middle class investors. Silly. All right. So anyway, a couple things. So I like the facts, guys. So let me show you guys something real quick. How you figure out the dividend and what the yield's going to be. All right. So right now you take, if I can get my trusty, I got to clean up after myself one of these days. I've been too busy taking out Christmas decorations and all that stuff. We're getting our dogs back tomorrow. A guy from the Army reached out to me today. He follows me on YouTube. I was like, man, I've talked about him before. But anyway, so we take the dividend, divide that by the share price. Or is it the other way around? I can't remember. 1 second. Yeah, we take the dividend. Let me just write this down so y'all can see this. All right, so we got 144 as a dividend. And we divide by the share price of 44.48. All right, and that's going to give you your yield. Right, so let me just go back to here real quick. All right, so stop. Hey, Brian, ¿qué pasó? All right, there you go. All right, so what you're going to do when it comes to dividend, you got your dividend, your actual dividend payout, divide by the share price, and that will give you your yield. So we take 1.44, divide that by 44.48. That's 3.23. All right. So that's the yield right there. All right. So question. What happens to the yield if the share price drops? What happens to the yield if the share price drops? Assuming the dividend stays the same, which I think is a safe assumption with Cisco. What happens to the yield if the share price drops? Who wants to comment on that? We're talking about Cisco right now. Right on, Vinyl. The yield increases, says TC. Yes, exactly. So the right on. So a lot of people, they get caught up in the yield only, and that's a mistake. Because I'm telling you right now, the mistake of saying the yield is the only thing that matters is silly, because the yield can also indicate that the price is way down, which is not necessarily a bad thing, but it might be a reason why the price is way down. So Vinyl bought it at 37. So it's 140. I'm assuming it's the same dividend payout at 37. So he bought it at 37. 144 divided by 37. So we take our trusty calculator, 1.44 divided by 37. He got a 3.9% yield. All right. Of 107,000 subs on this? No, I mean, you mean 1,000, right, Jill? Wait, I can't. There's no way I got 107,000 subs. On this channel, though, Jill, if you're talking about Josh Scanlon, the reason I don't have that many subs is because I literally did no videos for about 2 years. I mean, I started that channel just to kind of learn how to do YouTube, and then I just stopped putting any videos out there. And then when I got my ding, I said I need to start moving videos over. Actually, all I'm really, just for real quick, all I'm doing is I'm downloading the videos that I have in my YouTube, and I put it on a jump drive, and then I'm uploading it to the other channel. Just, they get repurposed essentially. But I don't want those videos. I don't want YouTube to delete all my crap in case they find that I don't. I don't have 107,000 subs. No. No. I got like 1,000. Anyway, so I just want to be cautious. So just because you see something, I appreciate that, Jill. Oh, by the way, I listened to old Carol. She did, her and Terry, I think, did a podcast yesterday that they're talking about microgreens. And Carol had emailed me, and she told me that she gave me a shout out on one of her blog posts. So just FYI, my friends, if you see my video on Carol Michael, Michehl, and she has a podcast called The Garden Angelist. Pretty interesting. I liked it. A big fan. All right. So anyway, let's go back to the dividend yield. So just be careful, because I hear people all the time, well, I got a dividend yield of 9%. Like that, the in of itself, that doesn't mean anything. I mean, it means something. I mean, don't get me wrong, but that's neither good nor bad. I mean, I'm just telling you right now, a dividend yield of 9% or something like that is neither good nor bad. If the average dividend yield is 2.5, we'll just say for the S&P 500, which is actually probably higher than what the S&P right now is. But just say the average S&P 500 dividend yield is 2.5, and you're getting 9% yield. That tells you something. There's something inherently off about that stock. Now, it might be off because the price has tanked so much to make it a value play. I don't know. Or it might be that there's the reason the price has tanked so much is because they're going to cut the dividend. Like, what was the consideration with Exxon? I can't remember if Exxon did. Anyone know? Does Exxon, do they cut their dividends? I frankly don't know. But that might be because the dividend yield so high. It's because the price is way down because they're getting ready to cut their dividend. Might be just because it's getting ready to be bought out by the Chinese communists. I don't know what it is. But anytime there's a discrepancy between the average and your dividend yield, the only thing that jumps out at me is the price on that stock is way, way, way down. And there's a reason for that. Doesn't mean it's a legit reason. It means there is a reason for that, though. They have not. Okay, good. So Exxon did not cut his dividend, which is probably why the stock has rallied. So I bought it. Literally, Exxon knew I bought 100 shares. 100 shares at whatever the hell it was, $4,000. But it knew. It said, "Oh, Josh bought it. Let's drop it. 15, 20%." and then someone else bought it. They must have thought I shorted it, so they probably got bad info that I shorted it, and then the stock is above my cost basis because they knew that because anytime I buy a stock, it tanks. All right, so let's go back to Cisco. All right, so let's go share screen. Vinyl, you still got Cisco as one of your holdings? Oops. So let's go back here. All right, so we see that. So they're making money. All right, so they got positive cash flow. They're not trading very expensively. It's just not. I mean, in the old days of, 15 used to be the average PE. 18 is high. And that's just silly because the average interest rate on the old days was 5 on a 10-year treasury. Now it's less than 1. So I hate that crap, but it's stupid. But anyway, that's not a high PE ratio. That's quite low in this day and age. So they're making money. All right. They have, $2.50 roughly earnings per share. And just remember, the PE ratio is you're basically paying $18.12 for every dollar of earnings that Cisco earns, if that makes sense. So that's what it means. All right, so now we got a dividend that are paying $1.44, which current price is a yield of 3.22. All right, in of itself, that doesn't tell you a whole lot. I mean, it gives me reason to investigate further, but that doesn't mean it's a buy or not. So what we want to do is we want to go to statistics. We're going to go to financial. Let's go to statistics first. This will be good. We're going to go to statistics first. And what we're going to see here is we see Cisco obviously had I don't know what happened here. And quarterly stuff I hate. One of the best things that Trump proposed that just fell flat was to get rid of quarterly reports. Let's just go annual, but be it as it may. You can see they have current $18.12 of the trailing PE. We go back to last year's 1824, and if you want to keep going back, you got to pay more. And I just don't feel like it. And there's a forward PE. All right, so you always got the forward PE is what the analysts expect for earnings for the next 12 months. You always got to be careful there because no one predicted September 11th, 2001. No one predicted the reaction to commie virus. There's just so many things that no one predicts. You got to be careful in these forward PEs. But let's just say this, these guys are even halfway right. So the PE ratio means that relative to current price, that their earnings are going to grow even more relative to current price. And I cannot stress this enough. I'm telling you right now, what happened at the end of the March of the coronavirus thing is that we had all these stocks that had dropped like a brick in water. The price went down and the earnings was still based on the trailing 12 months. So it looked like everybody's PE was at like freaking single digits. Well, I mean, it was, but the earnings were not reflecting the current state of the coronavirus shutdown. I hope that makes sense. I'm just telling you right now, I said this in videos. I said, don't get suckered into thinking the PE ratios are at historical buying opportunities simply because they're using the earnings before the coronavirus lockdowns came in, and they're extrapolating that on current prices. And the price was way down, but the earnings were still up here. That was bad. But I mean, it was valuable, but I'm telling you, got to be careful on their previous earnings relative to current prices, because there is is that the right word, dichotomy? I'm not sure what the word is, but anyway. All right, so so we got price of sales. That's what Meb Faber was talking about right there. 4 now, and Meb was saying back when he interviewed this guy is 3, and 20 years ago it was at 30. I'm always a fan of price to book. That's what I learned from my mom. My mom had taught me investing, even though she was an accountant working part-time at a gay restaurant up in Portland, Maine. But she enjoyed stocks, and she was always big on investing in stocks. I don't know where she got that from. She didn't get it from my grampy, certainly not my Grammy. So, but she always had the value line. Ben Graham, talk about Warren Buffett a lot, just all those things. And anyways, she always looked at price to book. My mom did. Meb was saying that this seems to be yesterday's, old fuddy-duddy, good time rock and roll anymore, that no one pays much mind to price to book. I think that's stupid, and we're going to get into this a little bit more in detail here in just a second. Price to book has always been fundamental. It's always going to be fundamental. That's all there is to it. It really is. So price to book is one of the 3 metrics of the old French family 3-factor approach, which is price to earnings ratio, price to book, and dividend yield to value stocks in particular. They've since added to that, but for the time being, P2B is a huge metric, huge. So right now, if they were to liquidate everything, you're basically paying 5 times for the complete liquidation of the company. Yeah, that's neither cheap nor it's, you can't really say if that's cheap or not, but relative to current environment, that's quite low. That means you're not paying much for the entirety of the company if they were to liquidate everything. So price to book's an important factor to consider for sure. PE ratios are an important factor. Dividend yields are an important factor. All right. So what we're going to do is we're going to look at some of these numbers here. You got to be very careful on ROE. All right. Return on equity, that's high. And you're trying to, generally speaking, rule of thumb with an ag look, I'm sure the numbers have changed, but generally speaking, 15% ROE is what you're looking at. I challenge that to some regard, though. You can jump your ROE, return on equity, by freaking leveraging to the hilt. And I'll just share with you. It's simple. Let's go into how you can make your ROE look fantastic. So we'll show you how it works. So we'll go to stop screen. So we're going to say you bought a house for $100,000. All right. And you only put 10% down. You only put $10,000 down. All right. So you have $90,000 of leverage. All right. So you got a house, fair market value of $100,000. 10,000 is your equity. 90,000 is your leverage. All right. What happens now? What happens now when the house increases by 10%? So the house increases by 10%. So your new fair market value is 110. 110. How much leverage do you have? Well, you still have $90,000, assuming you haven't paid anything down. But just how much leverage do you have? $90,000 of leverage. $110,000 is your fair market value, which means now you don't have $20,000 of equity. $10,000. Now you have $20,000 of equity. So your equity has doubled because you had $10,000 of equity. Now you get $20,000 of equity, which means your ROE, return on equity, is 100%. Do you see how that works? And that's because of the freaking glory of leverage. When it works like a freaking awesome. It's probably like the best investment you can make. Your ROE has doubled because you're leveraged to the hilt. So when you're looking at a company that has high ROE, the first thing you got to say is, are they heavily leveraged? And that's what we're going to look at with Cisco here for just a second. Leverage is debt. Just always remember that. Leverage is debt, man. Leverage is debt, okay? Do not let people say, oh, leverage. Now, that doesn't mean debt can, debt put me in this house. Debt put a lot of you in your homes. And the leverage probably worked pretty well for you. But don't let leverage in of itself to confuse you that you're still taking on debt. So let's keep looking back at Cisco. So I see that pretty high ROE. I said, well, that's interesting. How heavily are they leveraged? And so what we're going to see is you can look at earnings right here is earnings before interest, debt, interest, taxes, debt, amortization. This is what all the quants are going to want to look at. EBITDA. At the end of the day, there's something I want to look at that's even more important than that, in my opinion. All right, so we see their quarterly growth revenues down 9%. In of itself, that doesn't shock me given the coronavirus stuff, but be that as it may. All right, so what we're going to, this is a huge one right here, the balance sheet. What's their cash holdings? $30 billion according to the most recent quarter. They got $30 billion of cash. What's their debt? $15 billion. Now, for me, that's fantastic. That means they have a 2-to-1 cash over total debt. Now, their total cash per share is $7 right there. All right, so that's good. That means, A, they can afford to keep paying their dividend for sure, just with the cash alone. They're also making money so they can continue to pay their dividend. If they want to spruce up the stock price, they can easily raise their dividend for sure. All kinds of different things going on. But what I'm seeing here is I say, okay, so if you're buying the stock, what was that, 44? 44. Immediately, $7 of that is just your cash. You're paying 44 for $7 of cash. Now, and if itself, what we want to do in the old days is what Ben Graham would say, and I was just listening to my man Toby. Some of this stuff is fun. I'm not going to lie to you. I enjoy doing this to some regard. But basically, you're buying a company. Let's say, would it be a worthwhile investment to buy a company at $70 if it had $100 of cash per share. Does that make sense? So you could pay $70 per share and it's sitting on already $100 of cash, of free cash. That means it's not, there's no debt assigned to it or something like that. The answer, of course, you got a $30 upside just right there. Now, you're not going to find many companies that do that, at least in the large cap area, but still, that's one thing of value stocks. Can I buy a company that's trading less at its cash? If the answer is that, you should freaking buy that sucker, man. I'm telling you, I don't, you have to look at the debt. I mean, the reason it might have all that cash is because it got significant debt too, but I don't know. But as we sit here today, I'm like, $30 billion of cash on $15 billion of debt. They have total debt to equity of less than 50, which means 50% is, 60% is their equity, 40% their debt. That's good. That's what you want to see. They have a current ratio of 1.59, which means they have more than enough in accounts payable, liquid cash, short-term reserves to pay off their short-term debt. So anytime you get a current ratio of over 1, that means they have enough liquidity. Do they use accounts payable? I think they do use accounts payable to cover all their accounts receivable, all their short-term debts, their short-term obligations. That's what you want to see as well. So book value per share is $9 again. So that's 5. So we're at 4, 5. Book price of book's 5 because you got. Well, I guess what you do is you take $9. You take the price of the shares, 44, divide that by the 9. Yeah. So book value is 4.88. Price to book, I should say, because you're taking the current price divided by the book value, and that's your book value per share. Anyway, so a lot going on here. I'm liking this quite a bit. Trailing dividend raise, $1.43. So they raised their dividend by a penny. I'm not sure if that's the last quarter or the last year. I don't know. We'll have to look at that. All right, so we like seeing all that. I also like the fact they don't split their shares, not that they need to, but they did split in 2000, which doesn't surprise me at all. I'm not a big fan when companies get engaged in splits. That's all shenanigans to get their price on ignorant people think, oh my goodness, the company split. I can just double my value. It doesn't work like that. I don't really pay much mind to the shorts. They got 37 million shares outstanding short. That's not very high, but people pay attention to that a lot. I don't. I mean, I guess you could, but for me, I just don't care. All right, so let's keep looking. All right, so also I don't really pay too much mind to the 52-week low and high. Sometimes I would, but in this last year, I think everything's kind of been sent to the freaking dumpster fire of 2020. All right, so far so good. I'm like seeing that. So let's go to financials as well. I do want to see what their debt load is, and what we're going to do, I do like to look at, are they profitable? The answer is unequivocally yes. All right, so we see pre-tax income right there, $13 billion. Net income to common shareholders, $10 billion. That means they're making enough cash flow to certainly pay the dividend. And we'll see how much they actually pay on the dividend. But they actually got more than enough profits to pay the dividend. And they're sitting on all that cash, which can also be used to pay the dividend, if that makes sense. So they don't have to borrow to continue to pay the dividend, which I freaking hate. Companies do that all the time. They have to keep the facade of a strong company balance sheet, and what they do is they take on debt in which to pay the dividend. I don't know, that's bad news. I'm just telling you right now. And again, I'm sure there's stocks that prove me wrong. Don't care. I would never buy a company that's borrowing. I mean, if it's a one-time thing, it's one thing. But if they're borrowing consistently to pay a dividend, that means they're not making it from cash flow. That's like the U.S. government, man. You know, they're borrowing to pay this freaking stupid stimulus. And by the way, this stimulus isn't socialism. Who said that, by the way? McConnell, the stimulus isn't socialism. Freaking, I hate. Why do Republicans, I don't understand. You shut us down, you freaking fools, man. No one wants your stupid stimulus, but you allow this to happen. It's not socialism, freaking clowns. It pisses me off. That's why frustrates me no end. That's why Trump was such a wonderful thing for the Republican Party, to make them freaking pull their head out of their butt. Unfortunately, Trump won't be around, and yet we'll still have Mitch McConnell. All right. Drives me up the wall. All right. So we see net income. So they're making money for their shareholders, which I like. Let's see. We see interest income. I want to show you. So earnings before interest and taxes, earning for interest, taxes, debt, and amortization. All that stuff's fine. And then we're going to see total net income. That's all good. All right. But they're making money. So what I want to show you, that's good. I like to see that. I want to show you the balance sheet where cash flow, I think, is right here. I want to show you the dividend that they're paying. Where was that issue of debt? Financing cash flows. Was it right there? Cash dividends paid. So they paid $6 billion in dividends. All right. $6 billion of dividends. That's what they paid right there. And that comes out of the cash flow. That's a hit to cash flow. That's a debit to the cash flow, $6 billion. So I'm like, okay, they got $6 billion of trailing 12 months. What they pay in dividends in 2019? $5.9 billion. What they pay for dividends in 2018 is $5.96 billion. 2017, 5.51. So you can see where that's going. They've been raising their dividend payouts each and every year for the last 5 years, which I like to see that for sure. All right. So then we want to see, what else I want to see here? Issuance of debt. Nothing. I like that. So they didn't issue any debt in 2020, and they actually paid debt back. I like to see that. Now they are buying their own shares. That's what that is. So I love this. So free cash flow. All right. They paid $6 billion of dividends. They got $15 billion of free cash flow. That's good. That's good news. So I'm liking all that for sure. But I also like to see that they're paying down their debt. They didn't issue any more debt. I like that. So that's all good. All right. So I'm very keen on that. So let's look at the balance sheet, because here we're going to see the debt here. And all I care about really is we want to see, there's a tangible, we want to see total debt right there, $14 billion. All right. We've already discussed that. That's a lot of debt, but look at what it was last year: $24 billion, $25 billion, $33 billion. They've been paying down some debt like freaking drunken, the opposite of drunken sailors. So I don't know what's going on there. That's fantastic. Look at that. They haven't issued any new debt. They're making cash money, and they've been paying down their debt like crazy. I'm a huge fan of that. Huge. I don't know what's going on there. I don't know. Frankly, it doesn't matter what I do know. I just know they don't have as much debt as they did. And they're still making positive money in which to pay the dividend without taking on debt. And they're still sitting on cash over debt by a factor of more than 2 to 1, which is fantastic. So we go to total assets. We see current assets. Current assets are your short-term stuff. And we look at these guys right here. They got $24 billion in cash, $10 billion in receivables, which looks like they've been carrying receivables that big for 3-4 years now. If this jumps up out of nowhere, that would be kind of concerning. That means they're not collecting. They're not getting paid on the people who owe them money. I don't like that. But that's not anything off what they've been having for the last 4 years. So then we look at total liabilities. Current liabilities are $25 billion. So again, they have payables and accounts receivables are about a third of what their accounts payables, about a third of what the receivables are. Current debt right here is only $3 billion. That's fantastic. Current cash is $29 billion, and you can see cash and equivalents, short-term investments, and then cash and equivalents. So they got more than enough money to withstand any kind of rocky times there. Now, should you buy the stock? I don't know. I'm thinking about it. I'm thinking about buy 100 shares. But I'm a big fan of that. I like seeing that quite a bit, actually. So that is Cisco in a wrap up. And there's no reason to think that their dividends are going to be collapsed. I literally could care less what the analysts say. The analysts don't know their butt from the hole in the ground any more than you and I do. They just don't. There's no insider trading. There's just no one knows. What I see, 15% estimated rate of return. I frankly could care less. All I want to know is, what is their price to book? What's their price to earnings ratio? What's their freaking price to book, price to earnings ratio? What's their dividend yield? And can they carry the cash to continue to pay that dividend? If the answer looks yes, it's probably a buy. I'm not saying you should buy it. I'm just saying something I'm looking at doing too. And all right, so let's you got it, Michael. There you go. Good point. So Vinyl says you should look at the terms and conditions of the debt when it comes due. I completely agree. at the end of the day, that's what the board, hopefully, and the CFO and stuff like that. Cisco's not getting taken to cleaners by giving up the freaking goose to corporate, the Warren Buffetts of the world. So, 25-year commercial paper at 2%. If that's what they got to finance their, that's that's fantastic. Yes, I agree with you 100% there, man. That is fantastic. All right, so yeah, buying shares back, basic share, buy. So there you go, buying shares back. You go to right on pulverizer. They had 5 billion of shares outstanding, and now they've reduced that by 750 million shares. Well, inherently, paying dividend, buying back shares, paying dividend, buying back shares. Both things juice the share price, in my opinion. I got no qualm with that at all. That doesn't bother me. I don't have any qualm with people when companies buy back their shares. Didn't freaking some idiot say they want to stop companies from doing that and instead use the money to pay the workers or something like that? The hell is this, man? Companies do whatever the hell they want to do, man. I mean, look, even the stupid mask, I hate it, but it's a company can do whatever the hell they want. This thing is dumb. But if the company wants me to wear a mask in their stupid store, that's their prerogative. I got no qualm with that. I don't have to go. Kind of like what I always said about smoking. It's stupid to tell the company from Richmond, Virginia, that they had to ban smoking. I was like, what the hell? People put your freaking big boy pants on, man. You don't like people smoking in the restaurant? Don't go. And if enough people don't go, then the restaurant's gonna have to change their tax. Crazy that individuals, adults, can make up a decision for themselves. Let's see. Yeah, well, looking at lots of shorts can give you a sense of lots of shorts means people think a doom's coming. I completely agree with that. I bet if you look at Tesla, there's tons of shorts there too. All right. You can't pay debt with the intellectual property or goodwill, 100%. You have to look at the nature of assets, and they kissed the boat of what they missed the boat on WebEx. Yep. Completely agree. All right, so let's look at the other one this guy was talking about was Intel. All right, so let's go to Intel, and then we're going to look at some small companies ones there too. All right, so let's look at Intel, and I'd never really traded much. I keep thinking Pablo's out there with Cisco when I was an active trader at Schwab, but Intel I did a lot. I sold a lot of covered calls on it. Very active in Intel, and we're just going to kind of do the same thing. So again, I'm just going off what this guy was talking about. He actually seemed to like Intel more than Cisco. And there's their stock at 74.88 in June 2001. Here it is now at 49.82. 20 years later, it's crazy. Same thing, 2.65 is their yield, 1.32 is a dividend. PE ratio is only 9.75. So that's interesting. That's quite low. And that would make me say, why is that so low? The market cap is still 204 billion. Huge shares outstanding volume. I mean, it's, again, but that right there is interesting to me. Why is that so low? That's the thing, because that's significantly lower than anything else that's out there. And Intel is not like, it's not like no one knows who Intel is. And interesting too is that they have that low of a PE ratio, which again means the price is low, or the earnings are through the roof. I think the price is quite low, and they're only paying 2.65 as a yield. So that's of interest. All right, so let's take a gander at Intel. Let's go to statistics first and foremost. Trailing, look, yeah. So PE that only goes back to last year. Never mind. So 14. That's interesting. So the price to earnings ratio has dropped significantly. That'd tell you either the price has dropped or the earnings have gone up, or a combination thereof. That's interesting. So let's see what's going on there. Okay, I don't have premium. So why is the PE so low? The price didn't look like it dropped over the last year. So let's just take a look, shall we? I guess it did. Oh yeah, there you go. So the price has fallen off a cliff. It hasn't come back. It's fallen and can't get up, and it hasn't come back since March 20th. Look at that. All right, so sweet. There you go. There's your reasoning for why the PE ratio is so low. The price has fallen off a cliff since the beginning of the year and hasn't come back. That's interesting to me. All right, so let's take a look we looked at statistics. So there's the reason why the PE is so low. We're going to look at price to book. Ooh, 2.74. So yeah, the price to book, the PE is quite low. They got a dividend yield higher than the average S&P 500. The classic value stock for sure. That's good. I like to see all that. So let's look at financials. We're going to look at. Hold on just a second. Okay, bear with me just a second. Where was I looking here? All right here. Yeah, they're making money, man. Was this quarter by the year? Yeah, so it looked like 2017, they still made money, but they didn't make a huge amount. 2018, 19, 20, they're increased. Well, not, but still they jumped up quite a lot on net income. That's good. I like to see that. Total revenue, $78. Man, they're making money. There's no other way around that. And the whole reason you invest is because the company is making money. That's fantastic. I'm liking seeing that. That's for sure. All right, let's look at the balance sheet. And let's look at current assets. Yeah, so $4 billion in cash, $9 billion in other short-term investments, a lot of receivables. That always kind of concerns me, but that's been growing. I don't know what to make of that, and I can't go back further. But anyway, all right, so there's the receivables. Let's look at, let's see here. The book, okay, yeah, total debt. All right, so how much cash they got again? They got $13 million in cash. And cash equivalents. All right, so that's 17. Let's see here. Yeah, there you go. All right, and then we go down to so they're definitely not taking huge amounts of debt. I like that. That's interesting to me. I mean, they've taken a little bit, but not a huge amount. Let's look at the income statement or cash flow, I should say. I want to see how much they're paying on their dividends. Investing cash flow. Net PPE purchases. Oh boy. Where the hell is their dividend payouts? Repurchase of stock right there. So they've been buying stock back like crazy. Repayment of debt. They did issue a lot of debt this year, so that's kind of concerning. I don't know what that's about. Cash position, financing cash flow. Cash dividends paid. So $5 billion in cash dividends. So they've increased their cash dividends by $500 million in 4 years. Their debt, they took on some debt, and but in this day and age, taking on debt in of itself isn't the worst thing ever because the rates are so flipping low. But still, that always issuance of debt, 13 billion, and of that 13 billion, they bought back 17, almost 18 billion of stock. Yeah. They got $3 billion in cash. So they got $3 billion in cash. They paid $5.5 billion in dividends. Yeah, that's a little. I want to see real quick what their current ratio is. Hold on just a second. Current ratio is still that's still good. That's fantastic. I like to see that. Total cash per share $4. What's this trading at right now? 49.82. Anyways, that's of interest to me as well. That might be something worth taking a flyer on. Debt to equity, they're right about 50-50 there. That's not so bad. Book value per share is $18, which means their book price to book ratio is what we say is about 2.5. Yeah, 2.5. That's all pretty good. That's a value stock, a classic value stock right there. So that's of interest to me. Those would be two that would be on my list. And so then when we go over to the Vanguard VTV, I noticed that it was interesting because I own this. This is my biggest holding by far is VTV. And I said holdings, let's take a look at the holdings of old VTV. And it was interesting to me because Cisco was not in the top 20. And I think Intel was in the top 20, but wasn't in the top 10. But Cisco was, I thought I could go to see more here. I was on someplace where you could see more. And let's go to Vanguard.com. We'll look at VTV, the holdings. Anyway, Intel was in the top 20, but Cisco was not. And we're going to go to VTV, which meant for me, I'll probably add Cisco on Monday. Let's look at holdings 1 second. Portfolio holdings. There we go. All right. There we go. Cheese Louise and blue cheese. All right. So we're going to see, do like that. And Intel right there is like number 11 at 1.5. Now, again, this is my biggest holding, but the Intel proportion of my total portfolio, given that my biggest holding only has 1.48% of it in Intel, doesn't make Intel a huge position that I own, that's for sure. But we keep going down. You can see Cisco's way down here, which is interesting to me. So I was like, oh, that's pretty good. I like to see that. And there's my ExxonMobil. So I might be adding Cisco. I might actually add Intel as well, buy 100 shares of each on Monday. We'll see. Just because I say that doesn't mean you should. Trust me right there. In fact, if anything, you should short it knowing what I'm doing. I do have some concern about some of these banking stocks. Bank of America, I thought I saw Wells Fargo in here, JP Morgan, Bank of America. Didn't I see Wells in here? Maybe not. I thought I saw Wells Fargo in there as well. I do have some concern about the banking stocks to some degree, but Citigroup, I saw Wells Fargo in there. But anyway, look, I'm not getting out of this. I just I'll reduce some of my position here to buy up some of those stocks just because I do think that there's some opportunity in those things for sure. All right, so let's look at this too. I want to go to another where was I? Back test right here. All right. So I want to, let me go out of here. Yeah, so Pulverizer says Intel's his biggest stock holding. They managed to make AMD and Intel, they still fighting. They've been fighting for 20 years. That's funny, man. I remember AMD, Intel was a cat's meow back when I was active in it, and AMD was a challenger. Has AMD supplanted Intel now? You can see I literally don't follow this. Can't be late, Mac. Ban for life. Microsoft looking to make their own processors for the servers. Yeah, yeah. I mean, that's the thing. This is always things that are out there for sure. I mean, it's just tons and tons of stuff that could affect things. You know, can we admit with Tesla, the big thing is the revolution on batteries is what everyone's waiting on. They think if anyone can do it, it's gonna be Tesla. I don't know. But I mean, is that worth paying that price? I don't think so, but I get it. People think so. I frankly don't. I will never own Tesla. I'll never own Amazon. I'm sorry. At $90 PE ratio at Amazon, nosebleeder. Now trust me, I recognize. I said that in 2016 when Amazon first turned its first profit and their PE ratios at 1,000. I'm just telling you right now, man, it's if you've been around a long time, you've seen this play out before. That does not mean Amazon's going bankrupt. Doesn't mean it's not going to grow to the biggest company that God has ever created. Doesn't mean anything. I have no clue, but I'm just telling you right now, it feels like I've been through these times a couple times in my history where some stocks or everyone's cat's meow, and then you wake up 5 years like, yeah, what happened? And I'm just telling you, we'll see. But a lot of the technology stocks is actually interesting. Listen to my man Meb talk to this guy Toby, because Toby says basically the 3-time value stocks have underperformed going back to like 1870s was major technological advancements. I thought that was pretty interesting because last basically 8 years value has just got crushed. All right, so let's look at, I want to go to, let's go to this guy here. Actually, what I want to do is I want to go to, so we're going to go to Market Watch, because I do like Market Watch when it comes to mutual funds. And we're going to look at a Royce fund that I've been a fan of for a long time. And it's the Royce Micro Cap Fund. And again, I'm not saying you should buy this. Please, I'm not making any recommendations. I'm just saying I've been a big fan of Royce. They run small cap shops with a value aspect, a component to them. And I've been a big fan of Royce Pennsylvania Mutual Fund, Royce Microcap. I don't own either of these right now, but I've been active in the past in Royce funds. But anyway, so let's take a look at Royce. I want to show you guys something. This is, I tell you, man, this is gonna blow your mind. We're going back to 12. Going back to 2007, 18, going back to 2004, 15, going back to 2002, 13. You see what? Now, this is just one example. I'm just telling you. I hadn't looked at this fund in a long time, but look at that. It's not advanced in terms of price. And you think, well, maybe it's got a lot of dividends. Not much. Look at that. No yield at all. I don't know if it's ever paid a dividend. Look at that, man. Nothing. For 15, going almost 20 years now. It's hardly moved the ball at all. I find that to be incredible. So let's look at that. We're going to compare RYOTX. Oops. And we're going to compare it to just good old-fashioned S&P 500, baby. We're going to compare these two. Wait, can y'all? Oh, you can't see what I'm doing. All right, let me go back here. Hold on just a second. And go to stop here. And we're going to go to share here. Watch this. So going back to 2000, to 2003, excuse me. I want to go to a second. I want to go to 2000 to 2020. Check this out. So here's the Royce. Here's the S&P 500. Now, the Royce actually hasn't done, going back to 2000, as bad as you would have thought. It's still, still almost quadrupled itself. But here's the S&P 500. Isn't that nuts? Look at that. Now, let's go back to the last 10 years, though, because this is where I think the opportunity is. Oh, this is fun. Look at that. S&P 500 is up 4 times, quadrupled. Royce is only up doubled in the last 10 years. So a doubling over the last 10 years still isn't that bad. But I mean, really, if you take away what it had from March until now, right there, I mean, it only made $18,000. The last 9 months has made all its money. In 10 years, it did nothing except for the last 9 months. That's it. Isn't that crazy? I find that to be incredible. I mean, just it's nuts to me. And then if you go back just the last 5 years, this is crazy. Oh man, that's not that. Yeah, it wasn't as bad as I would have thought, but it's not as bad as I would have thought. But anyway, The point being is that the small cap value stocks, I think Vinyl had made a mention of this. Yes, someone did made a mention of this yesterday. Haven't done much, man. Let's go to PennX. And that's micro cap. We'll go to PennX. And look, I'm not saying these are funds you should own. These are just ones I'm familiar with for small cap. Look at that compared to the S&P 500. Not that much difference there with small cap. That's over the last 5 years. I'm actually surprised that that's not as bad as I would have thought. I would have thought S&P 500 smoked that more. But if we compare that to, let's go to VUG. Let's see what that looks like over 5 years. Yeah, a pretty significant difference there over the last 5 years. So where I'm going with this is that the small caps just haven't had the same run, especially value stuff as a whole has not had the run. It hasn't for the last 10 years. Now, the interesting thing is, like I said last night, aughts to the 2010, value did better. 90s to the aughts, growth did better. The teens, the growth did better again. So it's just this it's this trade-off. It's crazy. And I find that incredibly interesting. And so as I'm sitting there thinking, okay, and I'm always contrarian, not going to lie to you, it's probably to my chagrin, but I am. I say, where is the ball going? Or where is Wayne Gretzky said the puck going, not where is it? And it just seems to me to be pretty obvious to me. If I can buy dividend paying stuff where the interest rates are so low, all right, well, cash is cheap to borrow if they need to pay the dividend and they're only doing a one-time thing. I want to buy stocks that have a dividend. I do. I want to buy stocks that are profitable. And I want to buy stocks that have a low PE. And those are all value stocks, growth, large and small. Someone pointed out yesterday, maybe it was Vinyl, I can't remember, talking about the equal weighted S&P 500. And I have that over here. I did want to, and I actually compared that, Frank, and I was rather EUSA. So let's look at the equal weighted S&P 500 to, we're going to look at VTI, and we're going to look at that for the last 10 years. I was actually surprised it wasn't nearly as bad as I would have thought. So equal weighted S&P 500 just means that they have 500 stocks in there, and they're all basically 1.5%, 2%. Each stock is 2% of the portfolio, something like that. All the same thing. So it has an equal weighted. So you have, instead of having cap weighted where some stocks are way overweighted relative to the bottom end, and like a huge seesaw, this is just flat, straight across the board. I was actually surprised to see the iShares equal weighted versus the S&P 500, and it wasn't that big of a difference. I was actually quite stunned on that. That was weird to me. So over the last, it's a little bit different. 10 years, 40,000 more for the S&P. That's not that significant. I was surprised by that. And then look, they're tracking like crazy here. I had thought the equal weighted would be way underperformed. And then if you go to 2000, I don't think we can do. I don't think. I don't know what an equal weighted I'm not sure. Can you do equal weighted? Equal weighted mutual fund going back to 2000. Let's see, equal weighted. Yeah, I don't know. Let's try that. See how far that goes. I don't think that's going to go back to 2000. Let's see. I know VTI, or wait, did I do VTI? Yeah, I did. I should have done VO. Yeah, pretty much the same. Does that go back to 2000? No way. All right, sweet. It does. So let's go I should have done VOO. Let's do VOO. Excuse me. No, it only goes back to 2016. All right, so let's go to equal weighted versus VOO. It's just not that much of a difference. I was surprised by that, actually. So I was inclined to think the equal weighted would be an opportunity to rebalance some risk. I don't see that there. That doesn't mean that's I was surprised by that. All right, so let's see what you guys have to see. Like I have something else I want to say on this. So we talked about small cap value. We talked about those individual stocks. Talked about kind of analyzing stocks. Seems like it's something else to say. Oh, I do want to show you just real quick. I do want to go back to, let's go back to Vanguard. And I'm going to show you the only way to ever beat the market is only one way to beat the market. Not that you should care to beat the market. I mean, who gives a crap? But people do. All right, so I'm going to show you the dividend growth fund from Vanguard, which again I own, my second largest holding. And what we're going to show you here with dividend growth fund, the only way to beat the market is with concentration. Number of stocks, 40. That's it. Number of stocks, 40. So if the market is the S&P 500, there's 500 stocks, and I have 40. And again, I was looking to see what was in here. And again, there's no Cisco, no Intel in the top 10. But again, if there's only 40 stocks, either that fund's going to be a dog or it's going to be a freaking, blue ribbon. One of those two things. It's the only way to beat the market. So let's see. I'm sure Cisco's got to be in here someplace. Marsh McClellan Insurance Company. I don't see Intel. Oh, look at that. Nope. I don't see Intel. I don't see Cisco in here at all. Interesting. So anyway, this is, if you're trying to beat the market, this is what you got to do. You got to take a concentrated risk, and you do that by buying a portfolio that doesn't have many stocks. I've talked about before on active share. Active share is a metrics you'd want to look at to see if a fund is a closet indexer, i.e. you're paying a lot of fees so it can mimic the index, which is stupid. You'll never beat the market there. Or if you're actually buying a portfolio of people who know or people are willing to take a risk on their certain shares, and they're willing to bet essentially their livelihood for it, because if they are smoked, they're never get another job in the industry, you think. Anyway, so that's one of the reasons I like VDIGX, is because it is high active share, 40 stocks, very concentrated. And if you're trying to beat the market, that's the way to do it. Only other way. You can't beat the market with a closet index. You just can't. And at that point, just buy the index and be done with it. And so a lot of people, portfolio managers and investment advisors, they're basically closet indexers who charge a heavy fee. That's stupid, man. I mean, it really is. You're basically buying the index, but you're paying 10 times the fee. Don't do that. If you're going to hire somebody, say, I want to see what your portfolio consists of. If he says, well, I have a diversified portfolio, it's how you get a diversified portfolio at Vanguard with one click. If I'm hiring you to make me money relative to what I could do on my own. That's called alpha. How are you going to produce alpha? Well, I have diversification, blah, blah, blah. No, man, I get diversification at Vanguard with one click. I want alpha. I want to outperform. How are you going to do it? And the only way they can do it is by being concentrated. There's no other way. There's just not. They don't do it by trading. They don't do it because they're going to keep you from making that big mistake, which is what they're using nowadays with advisor alpha. That's all stupid. The only way a guy can beat the market is by being concentrated and taking bets, taking risks. If you're going to hire somebody, that's what you hire them for. If you're going to freaking hire somebody to be a closet indexer, you just take your money, right? You roll it up into a freaking a spliff, a blunt. You take your lighter and you just burn it, because that's literally what you're doing. You're literally burning your money. You're saying, hey, guy, take my money, because he's not going to earn it for you. Doesn't make sense. Yeah. All right. So what says you all here? Yeah, Kathy Wood. Look, man, everyone and their moms talk about Kathy Wood. I saw this. Let's read up on Kathy Wood, Bloomberg. I said this last night, and I was stunned to see her say, hold on a second, right here. Look, I don't know who this person is. I got to go on with her. I mean, I've never heard of her until this last year. But again, I'm all that not interested in the active stuff here, but she sees 20% returns compounded for the next 5 years. I don't get how do you make that claim? I don't get it, man. I couldn't make that claim. I find that crazy to me. 20% compounded. Eesh. So if we take the rule of 72, we say, okay, if she's getting 20%, how long does it take to double my money? 72 divided by 20. I'll double my money in 3.6 years. So I put $100,000. Little Kathy is going to be worth $200,000 in 3.6 years, and then in 5 years it'll be worth. Well, I don't feel like doing it, but well, I guess I will. Let's say I had $100,000. I didn't make any other payments. I got 20% a year for 5 years. I would have $248,000 in 5 years. I don't know how you can make such claims. Crazy, but be that as it may, I mean, she might pay off. I don't know. I just find that the idea that someone can say that without having all the disclosures that I am subject to, it seems odd to me. Yeah, no, I 100%. If the Vinyl, good point. If the market, I think Vinyl said, yeah, if the market is crazy, the only way to beat the market is to be even crazier or to take a defensive position and wait for the market to fall. But that's not a winning scenario either, because historically the market goes up more than goes down. I mean, it does until it doesn't, but we don't know what it's going to be. I was sitting there today. I forgot. I was taking down my Christmas tree stuff, my Christmas stuff, and I was just thinking, the capital markets aren't going away because Steely Joe. It's not happening, man. I mean, the capital markets survived FDR, for heaven's sake, and Henry Wallace. The capital markets they survived Nixon. They're not going away. It's just not happening. Now, again, does that mean the government will get its tentacles in there and prop up stocks? Of course. I mean, will there be more regulation, more freaking boat building because the powers that be can manipulate the government to work on their behalf and hurt their competitors? Of course. Has this not ever happened? Of course it has. This has happened throughout the history since the industrial age. That's all there is to it. I mean, hell, it's happened throughout history. You're always going to have people who are going to scratch the back of the power brokers. I mean, hell, Chris Columbus, evil Chris Columbus. I mean, who is the lady? Queen, whatever her name was, Queen Anna, something like that. I mean, if there's freaking Joe Columbus didn't have the way to get in front of Queen Elizabeth, whatever the hell her name was, to get funded to come to America. You see what I'm saying? There's always some guy who's got the inside scoop on some guy who's just sitting there digging ditches. So there's always going to be a guy who's going to be ahead of the curve for sure. But at least with capital markets, and I'm not saying capitalism because this ain't it. It's not capitalism. At least that benefit can be seen by more than just the Mark Warners of the world with his fake telecom stuff and his was it Warner who was involved in the Haitian telecom scam? I know Clinton was knee deep involved in that. And if that was a Republican, they'd all be sitting in freaking Fort Leavenworth right now. But because it's Clinton and Warner and all these scumbags, they are out to go to Epstein Island, freaking crazy. But anyway, be that as it may, even though Mark Warner was able to manipulate his government connections to make bank, other people got wealthy along those lines too. It's just that will never go away. But the capital markets aren't going away. It's just not happening. Who's I've listened today? My man, Uneducated Economist. That's what it was. I think I did a video. We talk about regulating the shadow markets and stuff. And that's the issue that we have. The more regulation that we get, the more shadow markets that come. It's just all there is to it. And the drawback, frankly, is the more regulations you get, the less private companies are going to be private. What I mean is publicly traded. I should have said public. People think public government owned. I'm saying publicly traded, that you could buy them. More and more companies want to go private. And when they go private, they don't have to do with Sarbanes-Oxley. They don't have to do with all the crap with the regulations, the quarterly shareholder calls, all that crap. They just have less regulatory stuff to jump through, which means they can do a little bit more nimble, but you can't invest in them unless you're an accredited investor or know whenever all this stuff. Another thing I'm not going to do it tonight, but I am interested, again, going back to Meb. He's talked about a couple of times about farmland. I do think there's some value added there. I haven't looked into it too much, but buying some access to some farmland seems to be opportunities there as well. Med was interviewing a guy. It was pretty interesting. I haven't looked all that close into it, but as an accredited investor, you can have access to some of these that that other people can't. Some are private equities, I guess. But anyway, that seemed of interest to me too. So I want to look at a little bit more buying access to or holdings of farmland through partnerships, because I don't want to mess with that stuff. Something to think about. It's just, they're not making any more land, and land that grows crops, we need it. We need it, and especially land that grows crops that doesn't need electricity, i.e., through the power of the sun. The power of the sun. Take the sun's organic, 100% organic, and that's a big 100% organic. I'm not that big on organics because it's all heavily regulated by the USDA. I find that to be silly, but I do like the idea of regeneration, regenerative agriculture. We're rebuilding our soil and whatnot. And if you can do that as well as make a profit for shareholders and recapture the soil, I think that's good. I think it's good as well. So that's something I've been looking at as well, thinking about. 137 watchers, Queen Isabella, right on, and only 37 likes. Yeah, what's up, dolls? Like. They might be on the other channel, Eric, for sure. Roth says his ARK holdings are up 200% since he bought 2 years ago. Man, right on, man. Yeah, no, that's what I'm saying. Catherine was talking about her own funds. 100%, Ross. If I were to say I expect 20% rates of return on my investments, that freaking pisses me off. Solar fields and the farm fields, that don't get me started. If I were to say, here's my Josh Scanlon fund, I expect 20% per year compounding over the next 5 years. The SEC would be on me like white on rice. I would never be able to say that in an article I'd written. I'd never be able to get away with that. And I don't understand that. Hydroponics. I'm a fan of hydroponics. It still needs electricity, but I'm a huge fan of hydroponics without question. I just don't get it. I don't get why the industry allows some people to say some things and other people, financial advisors, we have both hands behind our back. It's freaking pisses me off. Insurance guys can say whatever the hell they want. I don't know if Jill's still on here, but she emails me every now and again about clowns on Facebook who are talking about their index annuities and how they can do this and do that. And you just look at it, you're like, that's completely misleading. How come they can say that? Kathy Woods can say she expects her portfolio to return 20% annually, compounding year over year for the next 5 years. I'm like, but a financial advisor can't say do a Roth IRA. It's crazy. That's why YouTube is full of these snake oil guys and very few true financial advisors, because they have to watch what they say, which is not bad necessarily, but that also means a lot of guys who are good at talking financial planning don't say what needs to be said in terms of stuff that we talk about here. It's frustrating me to no end, which is why I had to give up all my licenses and all that stuff. I'm never going back to the industry because I had to say what I needed to say. By the way, I had a guy really upset with me. He said I should, and I hear this, I get this a couple times a week, actually. And really, really angry at me. Really, really angry at me. Right on, Mac Attack. He's on both channels. He said, I like your stuff, but you're bringing a lot of noise with your politics and your anti-COVID stuff. And he said it was a fiduciary. Yeah, right on. The Facebook guy isn't too happy. Anyway, this guy was not happy with me. And I like I've said a million times a Sunday, I did not get on here to make people happy. I got on here to be cathartic for me because I've been in this business a long time and I just seen just crap out there. There's a lot of good financial planners, tons of good financial planners, but they are limited what they can say. And I know they're out there because they email me all the time. Say, thanks for saying what I can't say. It's kind of like, some of these guys, I don't know, friggin' Dave Rubin. Thanks for, being the voice of reason. I can't say what you're saying or else I get fired from job because I believe there's only two genders and stuff. Everybody knows this. It's nuts, but you can't say what is on your mind. But I do. And I know I get tons of guys. He's a guy who gives you a thumbs down. But I emailed him back and said, hey, I'm sorry I offended you. I'll make sure I email you before I do a video to make sure it meets your approval. And I said, look, dude, there's tons of other channels out there. I never was here to make everyone happy. The funny thing is these guys don't understand the business. It's also a business strategy, by the way. People like people. Do you get echo or a stereo? Who support their viewpoints of the world. That's just a fact. And when people are acknowledging their world viewpoints, they're more likely to look at that guy as someone they want to hire, man. It's just that simple. I mean, I don't understand why more conservative leaning companies don't do this. Liberal leaning companies seem to have no problem, which means the field is wide open for anyone who will be somewhat conservative. Just say you love America, man. You don't even have to say you love Trump. Just say you love America. And you'll know you're you're doing well when your enemies say, I can't believe they said they love America. Then you know you're making headway, and people appreciate you and they'll be loyal to you as long as you're loyal to them back. And I don't get it. I don't get why people on our side, the conservative right, don't recognize there's a huge opportunity to make headways with people who believe the same things you do, which, by the way, are the biggest voting bloc in the country. Now you got 30% liberal, 40% conservative, and 30% independent. And probably some of those independents are on the liberal side, but generally speaking, people who self-identify as conservative are the bulk. They're more than people who self-identify as independent or liberal. So just appeal to those people, man. I mean, look, if you're running a big where you're trading on volume, you might not want to, like a Walmart. You might not want to hire some SJW who calls Josh Hawley a sore loser. Hopefully that guy got canned. That's crazy to me. But if you're just appealing to a certain small segment of the population, because I'm just a one-man shop, man, me and my two dogs, you don't need a huge amount of people to be successful. You just don't. But people also want to know, and I hate to say authentic because that's so cliched anymore, but people also want to know that you're a real person, that they can trust you, that you're going to make mistakes. People are okay. They're forgiving. As long as you're honest, man. It's crazy. Anyway, can't put a flag in my yard, Jose or Joe's, because I live in an HOA. Yeah, never again, man. I was telling my wife today, this is my last suburban house. It's either going to be in the country or it's going to be in a small town where I can walk to the coffee shop or something like that. But it's never doing a suburban cookie cutter. And I like my house. I like my neighborhood, but I'm never doing that again. Okay, rent. All right. So basically he's because he's looking at the other channel rentals and rehabs. We got two channels going on here. I'm using StreamYards. We're using my Josh Scanlon channel and my Heritage Wealth Planning channel. So he just saw one for sure. Roth said he'd hire me to walk my dog. I'm good at my pups. Oh man, they're in training right now. I cannot wait. I can't wait till they come back. Tomorrow morning, we're getting the pups back, and I'm hoping they're gonna be trained so we can walk Pablo and doesn't scream bloody murder at everybody who walks by. Not only can you not say what's on your mind, you also cannot tell the honest truth. Yeah, 100%, man. Oh, I told him I wouldn't use an insurance salesperson as a financial planner. He hated that. And that's too bad because actually, this is what I've said a couple times, that if I had to redo it, I would have came up through the insurance ranks. They actually train better financial planners, believe it or not. But their better financial planning is all based on selling insurance products. That's the problem. They're good at financial planning, but it all results in insurance products. And it's just like, if they could just get rid of that and just be good financial planners, they would smoke the investment industry without question. Like my man, Rich Shag over at Magnolia Wealth Strategies. He's an insurance guy, but he's one of the best financial planners that are out there, even though he does sell insurance. But he also manages money. He's more than just an insurance guy, but he is an insurance guy. That's the company he runs, Magnolia Wealth, out of New Orleans, is an insurance firm, but he's more than that. And that's the kind of wave of the insurance going forward. I'm thinking that there'll be more and more insurance guys doing financial planning for a fee and also placing insurance products for a no load. I tell you, that's the wave of the future. So a lot of these insurance guys are going to have a leg up because they've been trained correctly. And once they go to no load insurance products, and they do financial planning for a fee, all the investment guys will be out of business. Literally, it's going to be out of business. No one's going to care. I'm so looking forward to that day. Insurance guys do no load insurance placement and a fee-based financial planning like what I do. And then the investment guys will have nothing to do. They'll have nothing to do because no one's going to want to pay 1% to put you in a diversified portfolio. I can get a Vanguard for 10 basis points, especially if you can't do anything else. I don't do insurance. Why? Because I'm a fiduciary. Well, that doesn't make any sense. I'm a fiduciary. I don't do insurance. That's freaking stupid. Then if you're a fiduciary, you're certainly not a financial planner. Well, I refer my insurance people out to who? Jake at State Farm. Does Jake at State Farm know what the hell he's doing? Well, I assume that he does because he works for State Farm. Yeah, that's not fiduciary stuff there, my friends. That's not fiduciary. I'm not saying you actually have to place the insurance. My God. If you're just sitting there thinking, I'm a fiduciary, I don't place insurance. Well, I need to get some life insurance. Who do I talk to? I don't know. You got to find a life insurance guy. Yeah, that's not fiduciary. Nah, I don't like that at all. That's funny. All right, my friends, I'm right on. That's good stuff. Oh man, Eric says I can piss by my shop and know whatever I know. Country living at its finest. Oh man. Nah, that's not too much information. No way, Ross. Now, if Eric said, hey Dan, if Eric said he could take a big old dump back there, I'd still say not too much information, but I get it. Dan's finally up here. What's up, man? Yeah. But it's still cold up there in Wisconsin, Eric. That's for sure. Still cold up there, but be that as it may, all you need is 15,000 California Republicans to move to Wisconsin, and Wisconsin is red forever. I'm telling you. All right, amigos, I can get out of here. Probably not going to do a live stream mañana. I think I kind of like Saturdays and Fridays. I kind of like doing them on Saturdays and Fridays, and this is my entertainment, hanging out with you crazy guys. It's fun though. Yeah, right on, Pulverizer. York, jeez Louise, everybody's late to the party. What y'all doing, man? Was a football game on? I don't know. All right, we'll see you guys. Thanks again for being here. Mañana. Or see you later.